Everybody, let me kick off this this presentation. What we're going to run through is latest data, which is basically end February data from liquidity conditions worldwide. We collect data from around 80 countries across the world, clearly the important ones and some of the smaller ones, many of the smaller ones as well. And what we're going to present here is the implications of that liquidity flow for markets. Our view is that liquidity is the critical factor. It is what's driving asset markets and ultimately will drive economies. And so what I want to do is to effectively bring together those facts in this presentation. The view that we've been having is that liquidity is going to continue to be important this year. Our view was that Q1 would be still pretty good for risk asset markets, but you're facing problems going into Q2 and Q3, where we thought there would be some reaction, some negative reaction for risk asset markets. And it will be likely by Q4 this year that there'd be a rebound back as investors essentially reassessed what would still be, we think, good economic prospects. But the problem that markets would have in the near term is effectively an inflection in liquidity caused by economic strength as working capital demands picked up, and more particularly as the bond market started to react negatively to signs of strong economies. The latest data you can probably see here on this chart, which is looking at the track of global liquidity in dollar terms. What you can see in the shading is the contributions of different countries. I think the key thing to really highlight, apart from the fact that the US has probably been instrumental in delivering most of the increase in liquidity in the last 12 months, is the rise of Chinese liquidity really over the last decade, which is the second shaded block up in the mountainscape diagram. China now accounts for a short 30% of global liquidity. It's very important. And one of the themes that we've had in our research and in the book that I wrote, Capital Wars, is all about the idea that actually the financial structure of the West is a lot more fragile, paradoxically, than China's is. The whole point about financial fragility rests on the dependability or the robustness of liabilities. And the problem in the West is that those liabilities are very flaky. You've got now a very pro-cyclical financial system that rests on somewhat questionable collateral claims, whereas China, it's still very much state-controlled and state-run. And I think for that reason, somewhat more robust. As you can see from the chart, what that's showing is that global liquidity is now about a short $160 trillion. It's been up 20% since the COVID crisis started. It's likely, we think, with commitments that central banks and policymakers have made, to test 180 trillion by end 2021, which puts it at about twice world GDP. That ratio has more than doubled in the last 20 years. What impact does liquidity have? This is a graph we showed before, but it's worth just recalling that the impact of liquidity on all forms of wealth, financial wealth, but also including here precious metals in gold, housing, and we could also include Bitcoin, which is or cryptocurrency, which is becoming a similar phenomenon. Liquidity tends to increase asset prices. You can see the evidence here, the black line being a measure of all world wealth, including gold and housing. That is trailing the movements in global liquidity by around about 6 months. The dotted line you can see on the orange line, there is basically our projections of the growth rates of liquidity year on year to end 2021. There's an inflection coming. That's clearly something to pay attention to. It's not necessarily red traffic light yet, but it's certainly something to be conscious of, that liquidity is not going to go up in a straight line forever. Growth rates will start to inflect, and maybe they already are. In terms of the momentum of liquidity, we use this index to track what's happening. The history of the index goes right back to the mid-1960s. It's been updated pretty consistently since the late 1980s, real time. by us. What we can see on that chart are annotations which highlight periods of both stress at the bottom and asset market booms at the top, in terms of giving some color to the movements. What you can see lately is that liquidity conditions rebounded very sharply from around mid-2019. That was the latest tantrum in bond markets around the summer of that year, when US Treasuries started to sell off aggressively and the Fed came in. That is just the latest of its QE episodes. One of the things we wrote back at the time of the global financial crisis was that QE was not a one-off solution. It was a series of pills those pills would extend right up to QE10, QE11, QE12, etc. It's an ongoing process, and we're just seeing that history unfold now. The inflection that you're seeing is important. Liquidity is not collapsing, but clearly it's beginning to lose momentum. And that's really something we ought to be paying attention to. It's not because central banks are tightening yet. It's because liquidity is moving away from the financial sector into the real economy. And that's something I think we need to pay attention to. This chart, the next chart, is exactly the same data, but we've fitted using artificial intelligence systems and spectral analysis, a series of cycles to that data to see how it is likely to unfold. Now, this is not necessarily a prediction. It's what it's trying to show is how the liquidity cycle could develop in the future. And what it's saying is that we're in a period of early downward movement. The text at the top says that if you look at the black line, it would likely go subpar from late 2021. The red line, I would say, is lagging that at the moment. So it may be another few months and well into 2022 before we start to see actual subpar liquidity. But you get the idea here. We've got to be conscious when liquidity is starting to inflect downwards and move towards more defensive or later cycle areas of markets. And that's really very much the theme that we're addressing right now. This particular chart is a new one that we've developed, and it basically is using principal components analysis to analyze all data releases from real economies worldwide against the consensus as illustrated on Bloomberg or put on Bloomberg. And what the data is trying to illustrate is an index which is showing economic momentum or economic velocity, as we say here. And what it's trying to illustrate or trying to show is that when that index is at very high levels, data surprises, positive data surprises from all economies worldwide in terms of their daily ongoing data releases are continuing to be above consensual expectations. So what this is saying is that economies likely have more momentum than the market is currently thinking. Now, if you look at this data which follows, this is actually hard data that we've got from business surveys worldwide and from world shipping activity rates, which is the red line. The two pretty much confirm co-movement, maybe reassuringly what you'd expect, but basically the data here is to end February. And what it's showing is the continual V-shaped rebound, contrary to what many economists have been arguing over the last 12 months or so. There's been a very sharp rebound in activity levels, particularly in manufacturing, and particularly outside of Europe, in certain areas of the US and certainly across Asia. So you're seeing this pickup. We're not saying that economic activity has got back to levels that we saw prior to the COVID crisis, but the momentum or velocity of the economies has rebounded sharply, and that's clearly important for the sentiment in asset markets and in terms of the use of liquidity. What does that mean for the bond market? The bond market is really at the center of all financial asset markets, and the US Treasury is very much in the center of that. And what we show here is the movement in the US Treasury 10-year bond, which is the probably the most important benchmark worldwide, shown in yellow. And the red line is a very simple factor model that consists of the US PMI index, the copper price, the gold price, and the Australian dollar, US dollar cross rate. So it's only those four factors. But those four factors alone actually tell you an awful lot about how the US Treasury market is likely to move. They're very key cyclical indicators. And what they show from this factor model in red, which is a contemporaneous guide, is that looking at the strength in this economic rebound, it would be not fanciful to suggest that US Treasury yields should certainly be in the 2 to 2.5% range, if not higher, as that chart is indicating. Actually, they should, in reality, maybe even be testing 3%. But the point here is that what you've got is an interesting picture where there's a lot of pressure on US Treasury yields. That clearly is not going to be great news for the stock market, and particularly for growth and technology stocks, which are effectively long duration instruments that get a lot of their traction from low interest rates. The middle period that we've highlighted here is the Shanghai Accord period, which began in early 2016 at the G10 meeting, when there was a non-publicized but tacit agreement among G10 members to basically expand liquidity during that period. And what you can see through that time is actually an increase in US yields from around 150 basis points at the beginning of that year to nearly 300 basis points, 3% by 2018. You can see a similar movement of a similar magnitude, again 150 basis points, in the 2013 Taper Tantrum. And I'd point you to the parallel between the sort of kink in that movement in 2013, where you saw this gradual increase in yields from about the middle of 2012 to early 2013, and then a very rapid jump in that yellow line through 2013, as the Federal Reserve indicated that it was starting to taper, or likely to taper, QE policy. Now, it's not the fact this time around the Fed will taper. I don't think they've got the nerve to do that right now. But actually, you've got a de facto tapering caused by the fact that real economies are strong, and real economies will need working capital that they'll take out of financial markets, and that will basically absorb liquidity. But there's another factor that we need to take into account, which is what we have spoken about before, which is the shadow monetary system. And this comes back to the fragility, or if you like, the pro-cyclicality of the monetary system in the West, particularly in the US. Now, what these two diagrams are trying to illustrate, they come from the book I wrote, Capital Wars, but they're basically trying to highlight the fact that if you look at the constituents or the drivers of liquidity, it's not simply central banks and central bank balance sheets, as that inverted pyramid on the left-hand side says. One of the most important elements of driving liquidity is the collateral pool that you see in that lower part of the diagram. And the collateral pool is made up of things like Treasury holdings. Now, a lot of discussion has occurred in the last 2 weeks about the supplementary leverage ratio of US banks, and the fact that that was suspended to take pressure off banks, and that is likely to be reinstated, as far as we know at least. And it may, the FOMC meeting this week may decide to continue that, the suspension of that. But effectively what it's doing is trying to cushion banks from including bonds in their leverage assessments and having to raise capital against that. What it's really saying is that the whole collateral pool is a critical element in liquidity creation. And if there is a problem with the value of collateral, what you're likely to see is diminished liquidity growth. In other words, it's not just about the central banks, it's about the value of this collateral that the private sector holds and can create liquidity against. Now, as the text on that top says, the fall in bond markets so far has probably reduced that collateral pool so far by around 4 to 5% this year. And you can say that that's actually having already a knock-on effect on liquidity. So if you get a situation where the bond markets go into free fall, in other words, yields rise more significantly towards this 2–2.5% figure we're saying, there is likely to be a negative effect on liquidity looking out. So in other words, what you've got is this pro-cyclical factor, which is starting to interfere with liquidity supply. The chart on the right is simply saying, in maybe a slightly wonkish way, that the collateral multiplier, which you can take as that brown line at the bottom, is much, much, much more stable than traditional money multipliers that you read about in economics textbooks. The money multiplier pretty much, I think, went out of fashion at the time of the GFC. It's collapsed, but the collateral multiplier has been remarkably stable. And what that's saying is, if you include the lower part of the pyramid that we show on the left-hand chart, that's what the brown line is basically indicating. And there is great stability between that and global liquidity. So a warning here is that bond market sell-offs are not good news, and we've got to be very wary of that looking forward. Now, you don't want to be in bonds near term for sure, but it may be also a watchword to equities. One of the reasons for that interaction is shown here, which is looking at the yield curve in red, the US 10-year minus 2-year spread, and US liquidity conditions advanced by 9 months. Now, way back in the distant past when I was at Salomon Brothers, this is exactly what we would use to understand the yield curve and trading the bond markets. It was all about flows, and if flows came into the market, positive liquidity flows, the yield curve would steepen, largely because term premia would begin to fatten. And when liquidity left, you would see the yield curve flattening, again in reverse because term premia were then narrowing. The movements in term premia are basically because 10-year bonds in this case are a safe asset. If there is abundant liquidity in the system, why do you need to hold safe assets? So investors get out of safe assets and move towards risk assets. So what you typically find is that a steepening yield curve is saying there is a growing appetite for risk. Investors will move towards cyclical equities, and ultimately money will go to fuel a rising economy. And that's what you're seeing now. The point to note is that you're already seeing the beginnings of this inflection in the US liquidity chart further out, but that I think is much, much more a 2022 and perhaps later story. But for now, the yield curve is steepening, and it's quite likely that that yield curve will hit a region of about 2 to 2.5%, which is entirely consistent with what we've been arguing, that the US 10-year bond will test 2%, maybe even get into the 2.5% area. So what you've got here is a lot of upward pressure on rates. This is not just about inflation pressures. I mean, we think inflation is rising for sure, which I dealt with last month in the presentation, but it's not really going to be runaway inflation. Inflation is much, much more a real economy than a monetary phenomenon these days, and the pressures on the real economy are not significant or so significant to cause runaway inflation, but inflation will nonetheless pick up. In terms of the pattern of liquidity, which central banks are easing and which central banks are tightening, what you can see here is the sort of picture globally, and you can see I think pretty clearly in this heat map, around about a year ago, we went from largely an orange to red backdrop to one which is almost totally green. The laggard is China. China is not tightening, but it's basically not particularly loose overall in terms of liquidity. Although, as I will say later, there is evidence to suggest that China is easing and is not running the sort of much tighter policy that many market commentators are suggesting. It's moving much more towards where the rest of the world is. A few other anomalies. Australia has sort of stepped back a bit, or in terms of its monetary accommodation. Switzerland suffered as safe assets of sort of fled Switzerland to go into risk assets. So there's been a bit of a de facto tightening. The emerging market area at 3 down from the top is purely reflecting China. Outside of China, other emerging markets have got fairly abundant liquidity. In terms of what does this all mean in terms of what we should be looking for, this little diagram tries to explain how this fits together in terms of the outlook for the bond markets, then the exchange rate, and from this you can take a message for stock markets. But basically what we're saying is that you've got to look at these 4 quadrants in terms of the impact that fiscal policy and monetary policy has on them. What you can see is that if you have a loose fiscal policy, in other words, you're moving to the left-hand side, and you've got a loose monetary policy, you're moving up the chart into the top left, that combination is nearly always about yield curve steepness. And that's exactly what we're getting now. The story is very much this year about steepening yield curves. And that's how you've got to think about how markets are moving. So there's an awful lot of consistency in what's happening out there, despite what many commentators are saying that the world is difficult to understand. What you're seeing is what you'd expect to see right now, steepening yield curves. The other quadrants are simply saying that if you get a situation where fiscal policy is tight and monetary policy is loose, that's when you're much more likely to get falling exchange rates. A strong exchange rate environment is one where fiscal policy, let's take this as a US, in terms of US benchmark. So if US fiscal policy is very loose and Federal Reserve monetary policy tightens, then the dollar will go up. We don't think we've got that yet. Actually, we think we're in a sort of a progressively weaker dollar environment, as I say. And then bottom right, just for completeness, tight fiscal policy and tight monetary policy is a flat yield curve. Now, what I've put in brackets after fiscal policy is private sector liquidity. And the reason being, from a flow of funds standpoint, is all money that is anywhere must be somewhere. And what that means is that if the governments are spending money, it must end up somewhere in the system. And what it tends to do is to end up in the private sector. Well, let's say it ends up in the private sector unless it doesn't. If it doesn't end up in the private sector, it tends to flow overseas into international markets. And that's really one of the things to watch. But certainly in the short term, what you see is that money tends to gravitate towards the private sector. So if the fiscal policy is loose, governments are spending, such as the latest Biden fiscal stimulus, that will mean private sector gets a lot more cash. And combined with that, Powell's monetary policy is loose. So you're looking at very clear yield curve steepness. The corollary of that for equities is you need to move towards cyclicals, or what many people call value stocks, but let's make it more straightforward, cyclicals, which will benefit from stronger economies. Let me address the dollar question and see what's going on, because the dollar is critical as well to the global outlook, and we need to assess what's happening. And I think there's a lot going on in the dollar markets. The way that we look at the dollar, and the way that we look at every currency, is to look at the mix of liquidity. It's not, as we keep stressing, about total liquidity flow that drives currencies. It's the qualitative mix between the private and the state or public sectors. And what we show on the left-hand diagram is private sector liquidity in yellow, and in the red we show what's happening in terms of Federal Reserve liquidity. Now, private sector liquidity is to a large extent driven, as the previous slide said, by what's happening on the fiscal front. So if governments are spending lots of money, you're going to get very strong private sector liquidity, which is what's happened. But if that money starts to move away, either into the real economy to drive strengthening economies to feed working capital, or it flows overseas into international markets, that yellow line will start to drop, and that's what's happening now. The way to understand this chart is to say whenever private sector liquidity is above policy liquidity, Federal Reserve liquidity that is, you tend to get a stronger dollar. When policy liquidity, in other words, the Fed is printing money at a faster rate than the private sector can absorb it, then you tend to get a weaker dollar. Money will then go into international markets. And that differential, which is what we call the Forex risk index, is basically plotted on the right-hand chart. On top of that, we show the DXY, the US dollar trade weighted index, as a deviation from its trend. And the yellow line, the Forex risk index, that differential from the left-hand chart, has been advanced by around 12 months. So what you can see there is that what it's indicating is not a collapse in the dollar, but it's saying that what you're getting is basically a soft dollar looking ahead. Now, I think we can say a bit more about that in terms of the detail of the next slide, which is just really a magnification of that left-hand chart, just to show what's going on. So what you can see here is the differential between policy liquidity and private sector liquidity. The period in from around 2012, 2013, right through until 2017, was a period where private sector liquidity outpaced Fed liquidity, and that was a period of dollar strength. The previous period, in the wake of the GFC in 2008-9, was when the Federal Reserve flooded the system with liquidity and the dollar was weak. But bear in mind, this is a forward-looking indicator, so you've got to add maybe 12 months to this to see the impact on the dollar. The period from 2018, 2019 was a period where basically what you've seen there is again a period of some dollar firmness, although less clear than in the earlier period. And then what we're seeing now is a clear drop-off in private sector liquidity, but still at elevated levels of Fed liquidity. And that's the risk that the dollar has. Now, one of the reasons that that yellow line is going down is that capital is starting to move away from the US. And this is a perspective that I think is critical to understand, which is the starting point we're at. And what this diagram is showing is regional capital flows into and out of the major regions as a percentage of global liquidity. The black line is looking at the Americas. The yellow line is Asia, China, Japan included there. And the red line is the Eurozone. Now, we show this chart, we've shown it several times before, but it's an important chart to look at. And what it shows is that there have been periods, 3 in particular, where there has been significant demand for US safe assets or US treasuries. And that has led to periods of strong dollar. The first of those was in the mid-1980s, when Japanese insurance companies began to buy the US Treasury market aggressively. And you can see what happened to the black line. It shot up very significantly, coinciding with or driving great dollar strength. The next period was the late 1990s, in fact, to be accurate, the 96 through 98 period, where you saw a spike in demand for dollar safe assets, which was the corollary or the other side of the Asian crisis, when Asian economies basically hit the buffers. The bubbles burst across many emerging market economies in Asia, and capital fled Asia. As you can see, the yellow line, rather like in the mid-1980s period, was the mirror image of the inflows into the US. The third period has been the period post the global financial crisis, which basically coincided with 3 events. One was Basel III and the demand for increasing safe assets. That demand was fulfilled by US treasuries largely because there was no supply from other economies. Principally, German bunds were actually falling in supply at that time through austerity policies. So the US Treasury market was really the only game in town. And then the other 2 events which coincided with that was the Eurozone banking crisis, which, as you can see, the red line there was negative through almost a decade. Capital flows are only just starting to come back into the Euro area now. And the other was what happened in China, where you saw a Chinese corruption crackdown by Xi Jinping, which led to flight capital in China, particularly through 2016, 2017. Now, the yellow line has sort of flip-flopped again and is coming down. That's not necessarily because of signs of capital leaving Asia in the same manner, flight capital. It's much more directed capital flows out of China in particular. And one of the things that China is doing right now is that the large trade surpluses that it's earning are being redirected in terms of foreign investment offshore. So one of the things China is trying to do is to manage its exchange rate, which I'll come on to in a moment. The black line, which is the mirror image of this, is basically falling. It's come down from the peak. Admittedly, in the last couple of months, it's picked up a little bit. It's absolutely correct to say that capital is not leaving the US net right now, but it's come down dramatically. And I think the key point here is that we're really dancing around that middle area. So the ability of the US to absorb a lot more capital is now much more limited. Now, if I then add to that this evidence, which is from the US Treasury, which shows holdings of US Treasuries, the left-hand chart is looking at the division of Treasury holdings split between foreign private sector holdings in orange and foreign official holdings in blue there. Both series are falling. There's been a sharp drop in US Treasury holdings since the COVID crisis, as you can see. The trend is downwards according to that chart, eyeballing it. So foreign Treasury holdings have peaked. And if you look at the right-hand chart, what it illustrates is private sector holdings. So just the private sector data here from that left-hand chart, but graphed alongside the inverted term premia on the US 10-year Treasury bond. And what that's trying to say is that when you start to see foreign capital leaving, bond term premia, in other words, the risk premia on US bonds, tend to rise. And that term premium has been wholeheartedly negative in the last few years, and it's starting to turn more and more positive towards positive territory. And in fact, if you look at the data, most of the factors that have driven the bond market in the last decade have been term premium related. So what we're getting now is we're being hosed by rising inflation expectations in the US on top of rising term premium. And that's what makes us particularly nervous still about the bond markets. What can we say about currencies and where you should position? What we show in this bar chart is earlier data on the flow of liquidity between the capital flows between various countries ranked. So if you're at the top of the chart, what it's saying is that our measures are showing capital leaving markets like Switzerland, Canada, Hong Kong, etc., and moving into markets that are at the lower part of that chart. Now, there are some obvious candidates here. Switzerland's been losing capital, but that's not surprising because it's really been a safe haven through the COVID crisis. And as people's risk appetite increases, they move out. Hong Kong, maybe Taiwan, two maybe political issues. If you look further down towards the bottom, a lot of money is moving into Russia, probably from a low base, admittedly, but that's probably just a reflection of the fact that oil prices are going up, so investors are moving in. Turkey has managed to attract capital, but that's not so surprising since the credit squeeze has basically caused the current account to turn around rapidly and has lifted the lira. Money is flowing into the UK, but generally the European markets. And this chart really just bears out some of the evidence that we're seeing that we saw earlier to say that money is moving back towards the European economies. And that would suggest that the euro, sterling, etc. are actually pretty well positioned against the US dollar. What's happening in Asia is that, as we've repeatedly said, in our view, what's happening is that Asian economies are basically targeting other peer currencies in the region, and they're basically trying to stabilize themselves against the US dollar. So most of the action in currency markets, what there is likely to be focused on euro US dollar cross. We still think that the euro is rising for the reasons that we've said. It's not because the European economy is strong, far from it, but it's because we think there's less flexibility in monetary policy. We think the direction of capital is towards Europe, and it's very difficult for the Europeans to control their currency. They really have to take it on the chin. Let me say a few words about China and to dispel the myth that China is tightening. One of the things that one often hears about in the media is that Chinese officials say that they're tightening policy, etc. I think one of the things to be clear about Chinese statements is that the central bank has two roles. One is to promote growth and one is to promote financial stability. Those that promote growth say they want to continue to expand liquidity in line with GDP. Those that want stability are saying that what they want is to basically restrict the bubble. And depending on who's making the speech, the media pick up a negative or a positive message. But broadly speaking, what's happening in China is that monetary policy is being run to a very large extent to keep the yuan stable. Now, that's point number one. And with a stable yuan, which is what it is now, they can afford to basically inject more liquidity into markets. The second thing is that the People's Bank of China, which controls the system, is basically focused not just on its own balance sheet, but on window guidance, or what used to be called in Japan window guidance, which is directed lending by the state-owned banks. And they listen and sit upright when the People's Bank speaks. And that lending is basically, they're told to hit various lending targets. Now, third point is that there is huge seasonality in Chinese liquidity figures and as well in the economy, because large parts of the Chinese economy are still agriculturally based. On top of that, there's the Lunar New Year holiday. So the beginning of the year is absolutely fraught in terms of the ability to correctly pinpoint Chinese liquidity. It's very, very difficult. What we do is that we seasonally and holiday adjust the data. We avoid double counting, and we take a broad view which looks at how the People's Bank acts. And what you can see here is a measure of total liquidity, broad liquidity in China, and it includes shadow banks and includes local authority bonds, which have been a recent tool of monetary control, and it includes the state-owned banks and the People's Bank. And what this basically illustrates is that there's been growth has accelerated from about August of last year. February 2021, in fact, was the biggest month for liquidity injection since March of 2020, at the time of the COVID crisis. So as far as we can see, there is no evidence at all that China is tightening. They're clearly not going to say and jump up and down and say, we are easing and we want to try and fuel a bubble. So they're always going to be cautious. But if you look at their hands, it's very difficult to argue that there's a tightening going on in China. So that is why probably economic data remains robust, and it seems to be giving positive surprises. What impact is that going to have on the broader world economy? What we show here is the CRB index, the year-on-year change in the Commodity Research Bureau index of world commodity prices in yellow. And the red line is our index of Chinese liquidity, advanced by about 6 months. And what this is trying to illustrate is that Chinese liquidity is absolutely critical for the world economy, for world commodity prices, and somewhere earlier in the pipeline, the Chinese economy itself. The whole point about the Chinese system, rather like looking at the old Soviet Union, is that the central bank is key to driving the state-owned sector, and the state-owned sector is still absolutely critical to the growth of the Chinese economy. So if the People's Bank expands liquidity or eases policy, what you get is a ripple effect where the Chinese economy expands, commodity prices get sucked in, and the world economy sees a cyclical upturn. And that, as far as we can see, is still going on. So commodity markets are likely to continue to rise, and that will be underscored by the revival that we saw earlier on in the presentation from the world economy as it gets out of the COVID crisis. Let me finish with some words about equities, but what I want to do is to put in terms of a perspective this chart and to try and see how, what the end game is here. And the end game may not be great, but the end game is worth thinking about. What you see is a chart which looks at two things. The red line is looking at our measures of global liquidity, and the orange bars are total debt in the world economy, excluding financials, the financial sector, which is an intermediary sector, but this is final debt holders, so households, corporations, governments, in terms of billions of dollars worldwide. This data comes from the IMF. The data that we put together is our own concoction coming from central banks and other vendors. But effectively what this is showing is that the two are moving together. Now, that is a remarkable, but actually very important fact. So what it's telling us is actually the debt liquidity ratio is remarkably stable. Now, that is in many ways the most important thing that all of us need to know in financial markets. And the reason it's so important is that what we've got is a huge appetite for debt in the world economy, which is being goosed by policymakers who are intent on keeping interest rates very low and trying to encourage more and more debt take-up, or so it would seem. The moves or the rumors that the Bank of England is going to go to negative interest rates may sound absolutely ridiculous, but they seem to be, for whatever reason, thinking about it. They're trying to stimulate debt take-up. Now, the issue is that, number one, if you have lots of debt, that's not just a one-off decision, because debt has to be refinanced. And the thing that a lot of economists and policymakers forget is this rollover. Debt is not forever, unless it's a perpetual, but there's not many perpetuals around. It has to be refinanced over a 1 year, a 5 year, or a 10-year horizon. And that rollover needs balance sheet capacity. And balance sheet capacity needs liquidity. So if you have lots of debt, you need lots of liquidity. But equally, as I tried to point out earlier on, that liquidity also rests on debt, because collateral is important for liquidity creation. So what you get is a debt liquidity spiral being created. And that's the fundamental problem in the Western economies. And ultimately, in fact, as my book Capital Wars tried to highlight, is that the whole problem about economically enfranchising China and industrializing China over the last 20-odd years is it's weakened the Western financial system. It's made it a lot more fragile, a lot more pro-cyclical, and standing against a Chinese financial system, which, despite what many people argue, is actually remarkably robust. They haven't had the financial crises we had and the repeated financial crises. So what you've got here is a cocktail which says the more debt you have and the more debt that's being taken on, it is still being taken on, the more you need liquidity. Whenever you get an interruption in that debt liquidity spiral, in other words, if debt expands and needs to be rolled over and central banks step back and do a quantitative tightening, you get this huge interruption or interregnum in markets where you get a tantrum and markets collapse. And so central banks have to come back in again. So they're effectively tied to this debt pool. Now, the reason that's important for asset markets, and I excuse this sort of wonkish equation, but it shows why we think traditional investing needs to be rethought, is that what it says is that if you take the left-hand part of that equation as the price earnings multiple, the valuation of the market, and you take L to be liquidity, E is earnings, GDP is itself, and let's say P is prices or market cap, what it's saying is that if you get rising debt, you're going to get rising liquidity. So a rising debt GDP ratio means that highlighted circle in the middle, the liquidity GDP, must go up hand in hand. So what you're getting is rising debt levels in the world economy mean that you get rising liquidity. So holding asset markets makes everyone look like an investment genius. It's straightforward. The other thing, of course, to note is you can get problems if the P to L ratio, which is the orange highlighted circle, is out of line. And that's what you've got to watch for bubbles. Now, as hopefully in the next slide says, if you look at that ratio between market cap and liquidity, the P to L ratio that we saw in that earlier chart, it doesn't seem to be a problem. Where's the problem with the bubble? There may be bubbles in PE multiples. That's because profit margins have collapsed and earnings have cratered because of the COVID crisis. But here what you can see is world stock markets in terms of the value of all holdings by all investors divided by the pool of global liquidity. There were clear bubbles in 2000, the Y2K bubble. There was a bubble ahead of 2008 at levels of 0.7 on that ratio, a higher 0.85 in 2000. But here we are now in 2021 at a ratio of 0.57, barely above its long-term average, and slated to fall back to about 0.5 by year end because of the liquidity that's being injected. So broadly speaking, what we would argue is that those two blades of the pair of scissors, the price to liquidity ratio and the flow of liquidity, as far as we can see on a medium-term view, remain in place. There may well be a question mark in Q2 and Q3 as liquidity demands from the real economy picks up, and there may be an air pocket, but that would be a great opportunity to go back and buy more. Now, final point is, which equity markets are still worthwhile buying at the moment, or where can you move for safety? Now, what we show is a little bit more, or a more sophisticated version of that previous chart, which is looking at all asset holdings, not just equities, as a part of a portfolio. And the mountainscape on the left-hand chart is looking at all financial assets globally, split between equities, liquid assets, fixed income, etc. And what we do on the right-hand chart in red, labeled risk appetite, is to look at the division between risk assets, largely equities, and safe assets, which are government bonds and cash. And that ratio, which is a normalized index, is shown as the red line labeled global risk appetite. Now, that fluctuates in a fairly set band of about plus 50, minus 50, or there or thereabouts. It's a normalized series, averages 0. The yellow line we put on top is world GDP growth. So what that's saying is that asset allocation is remarkably pro-cyclical. You tend to buy equities when economies are accelerating, and you tend to move out of equities when they're decelerating. There's no reason from a medium-term standpoint to avoid equities right now. As I keep saying, tactically, you may want to step back a little bit for Q2, Q3, but broadly speaking, what you can see here is a fairly comfortable chart. Now, what this next 4 charts looks at is the ratios of liquidity to, to equity holdings to liquidity in these markets, again, normalized and put in the same framework to make it easier to read. The tram lines are where you should really be focusing aggressively. So when you fall below the lower tram line, the minus 40, then just buy equity markets as if they're going out of fashion. And when you get up to the top tram line, then you ought to be thinking pretty seriously about exiting. In other words, what this is measuring is portfolio swings. Now, where we are at the moment for the big markets is that Japan and the Eurozone have got relatively higher levels of equity exposure compared to their normal levels, okay? The normal levels are different according to different regions. So in Asia, equity holdings tend to be low, cash holdings are bigger. In Europe, fixed income holdings are bigger, etc. But this is normalized for those effects. So 0 you can take as the normal asset allocation. If you're above 0, you've got higher and higher proportional equity holdings. Now, what that tells us is that the UK looks a screaming buy still. I mean, it's been affected by the COVID sell-off, the Brexit, concerns, all these things. It still looks to be very, very lowly valued against liquidity. Japan, the Eurozone, as I said, slightly higher, so there's less scope in those markets. Wall Street still looks pretty comfortably valued. And, you know, the point that we've made repeatedly in the last few months is that the anomaly in the US was what happened last March, April, where you see that big spike down where investors just fled the market. Ironically, it wasn't investors fleeing emerging markets, which was the sort of ongoing story in the Financial Times and other media. It was actually investors fleeing the big markets like Wall Street. That's what created the big opportunity. You've still got some scope in the US, although, as we say, it's probably much more in the cyclical parts of the market. So if you look at a ranking of all markets worldwide using the same metric of underlying portfolio exposure, what you can see is relative to the normal levels of zero, where are the best opportunities? It's in that lower tail. Markets like South Africa, which clearly are out of fashion, UK, New Zealand, Canada's down there, some of the big commodity markets, etc. US is about 3/4 of the way down, that chart, or 2/3 of the way down. As we've said before, if you looked at this chart end of March 2020, the US would be exactly where South Africa is now, right at the bottom. But it was at sort of -80, far out to the left. So it was a real extreme valuation, and great opportunity with hindsight, but flagged by this system as well. At the top of the chart, what you can see are markets where exposure looks to be high relative to normal levels. Sweden's a typically very cyclical market, and you can see Korea, as Taiwan, Hong Kong have been very strong markets of late, and they've benefited. Russia is really an oil price story. Asian emerging markets is the collective of all that, bracketed all those Northeast Asian markets. The red bars, just for reference, are regions. So you can see that developed markets generally still look better than emerging markets on average. It's not to say emerging markets don't look good, but it's just a lot of developed markets we still think look better. And equities still have scope, I think, to perform well. So finally, how does this pan out? What should we be looking at? Well, what we're saying is that global liquidity may be inflecting in terms of its momentum, but it's still likely to rise in 2021. It's going to exceed twice world GDP. The world's seeing a V-shaped economic rebound. There's no reason to argue against that. The evidence is stark, I think, even from daily data showing surprises. Watchword is strong economies rarely have strong financial markets, because money will be shifted out to fuel working capital demands. That's the story of the middle months of this year. Bonds are under pressure. That's a signal of that. We still think US Treasuries have got a long way to climb in yield terms, and that's a problem. Already what we've seen, just to put this in context, is that not necessarily in terms of size, but in terms of duration, this has been the worst bond market sell-off since the 1950s. You've never seen so many negative months back to back in terms of the US Treasury market. So this puts that into some perspective. Yield curves will steepen more. That means move towards value cyclical equities. Inflation may well be a threat in 2021, but it's much more focused on real asset prices and commodities than consumer prices. China's easing, February strongest month since March of 2020. I made the point about vulnerability of equities, and there is some evidence that capital is shifting out of the dollar. It's not a rapid decline, but the dollar is probably declining long term, which is not such a bad thing for risk assets on a medium-term perspective. So let me stop and see if I've probably got about 10 minutes or so for questions, to see if anyone wants to say anything or put anything on the chat or whatever it may be. So there we go. Any thoughts?
Michael, can I just ask a quick question on China?
Yeah, go for it. Go for it.
So in China, you seem relatively sanguine, and you mentioned that the crowd has been negative on China for a long time, and essentially what I derived from your comments was that China kind of avoided the great financial crisis, and because of the COVID situation, they didn't have to engage in enormous kind of spending. How do you view the fact, A, that they have a closed capital account, which obviously provides them with a safeguard from controlling their currency, and the fact that their borrowing is at such high levels, given that the SOEs have been borrowing a lot? Are you concerned at all about their debt to GDP, or given what has happened in the West now, you think that the West, by comparison, the US, Europe, and Japan, have gotten worse? Therefore, China doesn't look as bad.
Yeah, I think there are two or three things to say about that, Mark. I mean, they're all good points. I think the first is to say that if you look at where China sits in terms of debt to GDP, total debt to GDP, it's at the lower end of the range for all major economies. So Japan is actually one of the highest still, and no one's talking about the fragility of Japan, financial fragility of Japan, or certainly it's not current. I think the issue comes back to that if you look at financial systems, problems normally occur not so much with assets, but with liabilities. It's the fragility of liabilities that really are the problem. And you saw that very clearly with the global financial crisis in the West, where it was much more a liability problem than an asset problem. And it's that which basically, I think, focuses my mind on what you've got in Western financial systems is that basically a lot of liquidity is created on the back of maybe questionable collateral. And what you see is that collateral is very market related, market price related. So for example, if you want to borrow against collateral, that collateral, if it's bonds, is currently falling in price. So your ability to leverage up on a falling base of collateral is clearly limited. So credit starts to fall. Now, once you start to realize that, I believe the figure is 70% of Treasury new issues in the US are basically bought through the repo market, then you can see that there may well be problems afoot. And that is one of the issues that the US has to address, but not just the US, but I think, although it's a paramount problem in America, because the way that the auction system works and the dealer system works is that what you've got is a more and more illiquid, auction-based system to basically take up treasuries in an environment where the pool or the size of treasury issuance is escalating, and something may well break here. And that's why this supplementary leverage ratio that is being discussed in the media at the moment and may well come up at the FOMC this week is of such great importance. So I think that what I would say is that, number one, China is on the face of it more robust than the West as a financial system, either in debt terms or more particularly on who owns the liabilities. After all, they're state liabilities, and the Chinese state has got enormous wealth behind it that it can easily row into this if it needed to. So I wouldn't be that concerned. I think in terms of the second dimension, which is what's happening, what's China doing internationally, particularly with its capital account and whatever else. China basically is at the moment is sort of holding many of the cards looking forward, because what it needs to do is to financialize its economy and get off the dollar hook. And that's a theme which is not just being played out in a few months. It's a long-term 10-year, 20-year process. And what China needs to do to get there is to develop a trade credit market in yuan. Well, being the world's biggest exporter and importer, that's a pretty straightforward thing to do. And America did that in the same fashion after World War I. And that was how the dollar became the world's dominant currency, through trade credit initially. So China could easily do that. And it would force Chinese banks, it would force Western firms to borrow from Chinese banks for trade credit reasons. Secondly, open up its bond market to foreign capital, but it's doing that. And thirdly, create a digital yuan to allow peer-to-peer transfers, but it's doing that. So what China is doing is basically doing everything you'd expect to financialize its economy and get off the dollar hook. So I think that's underway. The other thing that it's doing is it's stabilizing the yuan and it's stabilizing the yuan both against other Asian peer currencies and against the dollar. So China needs a stable real exchange rate, and it seems to be getting it. So behind the scenes, I know a lot of people like to dish China and whatever, but actually it's in arguably in a worryingly strong position right now. There's a question I noticed from Ida. Do you want to, and if you can unmute or whatever, can you?
Can I say it by voice?
Yeah, do that, go for it.
Oh, it's a pleasure to speak to you.
Thank
Okay. Well, yeah, I don't know if everybody knows that they have to push on raise their hand. I think a lot of people are writing on the chat, and that's why. Okay, anyway. So do you put into your model considerations like, and I think you know who I'm referring to, I won't say his name, the risk of capital controls, because if we...
Hello?
Long-term yields below the inflation rate, then that would have an effect of lowering the euro and maybe raising the dollar, because the Eurozone probably has the worst situation of everybody. If long-term rates go up too much, they have a problem for private debt and public debt. I noticed that you don't really integrate this in your models. I was wondering why.
Well, in fact, I spent a lot of time last month on looking at the Eurozone, so I didn't want to go over that ground. But I think that, there are a number of questions that you raised. I mean, one is, what are the odds of capital controls? I think that, at the end of the day, let me take a step back. It's very, very difficult to do yield curve control. I would argue impossible to do yield curve control unless you do have capital controls. So I think that's one of the reasons why, realistically, the central banks are not saying they're trying to do yield curve control, or certainly those that have got more open capital accounts like the ECB and the Fed. The problem you can see is that, particularly if you look at the data I put up on the US, is that foreign money is leaving the bond market. And it's very, very difficult for the Fed to do anything unless it takes up the whole of the debt issuance. Now you might say that's the end game, that's what they're ultimately going to do. But I think there's a problem in all that. The paradox as well is that the way that the central banks think the bond market works is actually contrary, I would argue, to the way it works in practice. And that is that they seem to believe that if they buy the treasury market, what's happening is that they're keeping yields down. Well, actually, that's not true if you look at the evidence, because what they don't take into account is not just the supply side, but the demand side. Or in other words, what people are demanding in safe asset terms. If the Federal Reserve, for example, is buying treasuries through QE, what's happening is it's creating a lot of liquidity in the markets. The fact that it's creating liquidity means that the financial system on paper is more stable. There's less systemic risk with lots of liquidity. And so why should you need to hold bonds anyway? So the demand for safe assets drops. And every time in history you've seen QE episodes, they've always ended with rising bond yields, not falling bond yields. So I come back to that point. On the specifics of the euro area, and I won't be able to answer all these points, but on the specific of the euro area, I mean, my concern is that they don't really have the tools or maybe the inclination to stop the euro going up. And I think you saw that probably with Panetta's speech, last week, where he was arguing that you would have yield curve control, and that's what he wanted. And almost immediately he was sort of swatted back by Lagarde saying, we're not really going to do this. Or maybe not, or it was all very vague. There was great mystification surrounding monetary policy. I mean, some of the words that are used by Christine Lagarde, I mean, I don't understand what she's saying at all. It sort of goes back to some of the earlier days in the Fed, Bernanke and co, and they were just not clear in what they were saying. And I don't think you can do that right now. So I think the risk is that what you're getting, or what you will get, is a stronger euro, much stronger euro. Remember where the euro is against the dollar. It's on a real exchange rate basis. It's 30 or 40% undervalued. And that's, I think, the starting point to say. So if the euro goes up, it really crucifies many of the other Eurozone economies. maybe Germany doesn't get hit so much. But I think that, my perspective, which is maybe a contentious point anyway, is I think the whole direction of the euro area is shifting more and more eastwards. And you just got to look at German FDI to see that Germany is actually embarking on its own Belt and Road Initiative, but it's going from west to east, not from east to west. And it's moving towards Eastern Europe and Russia. And that ultimately is the way it's going. So I think there are a number of issues, big issues for the euro. Let me just go through there's a number of points on the chat, so I can read some of those out. From Ian L, there's one which says, when the dollar is abundant because of economic growth and trade is booming, the dollars in excess are stored in reserves in US Treasuries. Don't you think that the foreign holdings of US Treasuries are declining because the world is in need of dollars? Yes, that could be true. I mean, I'll come quietly on that. I think that could be an issue. But at the end of the day, that may well be saying anyway that the long-term capital flows are leaving the dollar, and there may well be long-term question marks. I mean, it's very difficult to see from the US Treasury data who's owning what. But I think what you're saying is that money is leaving treasuries but remaining in dollars. That could be true. Yeah, I accept that. But it's clearly a worrying factor for the bond market that what you're getting here is this point about money leaving and yields going up. The milkshake theory is still alive. The rise in US 10-year yields will prop the dollar up. Again, I think that's an interesting point. It's very widespread in economics to basically say that yields support currencies. If you look at the evidence, it's really, really thin. It's very hard to find any correlation at all between yield levels and currencies. It's actually it's much clearer the other way around. It tends to find that, you tend to find that if currencies tend to go up, it tends to drive, particularly the dollar goes up, it tends to drive yield spreads, not the other way around. One from Vincent, which says, what does liquidity framework say about sector rotation into growth relative to value? Very good point. What it says very clearly is you want cyclicality. I hesitate to use the word value because value is such a sort of almost pejorative term, but it's a loaded term and it means different things to different people. Basically, what you're seeing now is that people are investing with regard to the yield curve. So money is moving into financials, particularly US financials. It's moving into cyclical stocks, particularly commodities, and it's moving away from growth and longer duration areas. Technology is the ultimate long duration, and money is moving here as the yield curve steepens and bond yields go up. So I think there's a lot more scope for money to move out of growth into so-called value or cyclicality. Is it the end of growth or technology as a driver of markets? I don't think so, but I think you are clearly seeing a rotation here. Saying, with respect to liquidity moving into the real economy, what specific indicators should we look at to monitor this? I think that, I think there are two things to focus on, I would suggest. I mean, one is to look at inventory levels, which have been pared to the bone, particularly in the US. There's some signs they're picking up, but that's a very clear signal. I mean, it's inventory levels, not just in terms of goods, traditional goods. I mean, oil is is a commodity which is held in huge inventory, and the rise in oil price is another factor which sucks up liquidity. So I think these factors are key. But I suppose I would generally say look at inventory levels and look at commodity markets as signs that money is moving in that direction. A question from Honora, which is, there's a lot of factors moving asset prices, but regarding liquidity, what is your experience of the time horizon liquidity takes to affect asset prices? And it should be a much better track record than valuation. The answer is it depends on the asset class. Basically, what you see is that fixed income and forex markets tend to react first. That tends to occur over about a 6-month horizon and a 6 to 12-month horizon. And if I get back temporarily to the presentation, if I show you this chart, where are we? Here. This shows the relationship between liquidity and the yield curve. If the yield curve is the best measure of what the bond market's doing, you can see here that we've shifted the yellow line on about 9 months, so it tracks. Another indication is to look here at what's happening to currency markets. Again, the right-hand side is saying about 6-9 months. We've pushed it forward, I think, just about 12 months in this case, but about that sort of horizon. And then the other one is to look at the effect that the real economy we have here on the real economy and equity prices. If you take the right-hand chart, that's saying that the real economy tends to move coincident with, or momentum is coincident with movements in asset allocation and equity overweighting. And what that tends to suggest is that liquidity tends to lead the real economy. And in our view, it tends to be about, again, maybe 12 months, sometimes 15 months ahead of what's happening to the real economy. So in other words, put it another way, the big pickup that you're getting in liquidity, or got in liquidity in the last 12 months from the COVID crisis, takes probably about 12, 15 months to come through. So you should be seeing a big surge in activity, coinciding with the end of lockdowns. I mean, that would probably on the cards anyway. Martin Perry gives a question, which is, can you comment on commodity equities, especially copper, over the next 12 months? Well, I think there are clearly specific factors such as electric vehicles, which I can't really go into in this because it's not in the framework. But I think the key point is that that commodity markets really rest on two things. One is the currency of denomination effect, which is basically, what about the dollar? So if you look at what's happening generally to the commodity constellation, I think that's being supported by a gradually weakening dollar. So that's point number one. Point number two is, if you think about the other moving part in commodity markets, which is real exchange ratios, or the impact that the economy has. And to my mind, that increasingly rests on the most industrial economy worldwide, which is China. And as I tried to say, I think on this earlier chart, if you look at Chinese liquidity, it should be driving commodity markets, we think probably substantially higher. Very good. Any other questions we've got? Are there any more hands up? I think we've done those questions. Anybody that likes to ask any final questions, happy to unmute, or just unmute yourself or jump in, but hopefully we've covered most of the questions, I guess. Can't see anything else coming in. So one new message. That's just, thanks, people are dropping off now. Yeah, we've overrun by a while, so thank you everybody for attending. We'll do another one again next month. Any questions you have, drop us emails or whatever, and we're happy to try and answer. Thanks so much. We'll send the slides out as well to everybody after the presentation. Thanks again. Bye.